If there was one bit of bad home buying advice that I wish I could just erase from the world, it's this myth about how much savings you need to buy a home. And I'm looking at you, Dave Ramsey. So, how much money do you actually need to buy a home? Welcome back. In section 1, we talked about choosing the right realtor. And in section 2, about getting pre-approved and understanding your financing. Now let's talk about how much money you really need to buy a home and how to think about your savings strategically. Hi, I'm Brandon King. I'm a licensed realtor in Oregon and Washington. Let's talk about the myth. Many of the first-time home buyers I talk to have been led to believe they need 20% down to buy a home. And that sounds believable, but for most buyers, it simply isn't true. Yes, putting 20% down does have some benefits. The monthly payment will be a bit lower, no mortgage insurance, and maybe your lender will give you a slightly lower interest rate. All good things. But not only is it not required, for many, trying to save 20% before buying a home can delay the home purchase for years or even make it feel impossible. So here are the actual minimum down payments for the most common loan types. Conventional loans require as little as 3% down. FHA loans are typically 3.5% down, and believe it or not, VA and USDA loans require no down payment at all. If you have a significant nest egg and want to use it for down payment, great. But if you don't, it shouldn't keep you from owning a home. Let's see what these percentages actually look like with an example of a $500,000 home. 3% down for a conventional loan is only $15,000. And for an FHA loan, 3.5% down is $17,500. 5% down, still only $25,000. On the other hand, 20% down means you'd need to save up $100,000. That's a staggering difference for most people. While we all save with the best of intentions, doesn't it always feel like there's just another unexpected life event just around the corner, waiting to wipe out your savings and set you back? It happens to me like everyone else. Let's talk about the potential cost of waiting to buy a home until you've saved 20% down payment instead of buying a home with 5% today. Let's say you buy a $500,000 home today with 5% down, that's $25,000. Now your buddy Dave also has $25,000 saved, but Dave wants to wait until he has the full 20% down, so he needs to save another $75,000. Dave cuts out his daily venti iced white mocha with vanilla sweet cream foam and extra caramel drizzle, starts packing sack lunches, and he cancels his Netflix. He's committed. Let's say it takes him 5 years to save that extra $75,000. Now back to you. You bought the $500,000 home with $25,000 down and a $475,000 loan. At 6% interest on a 30-year mortgage, your principal and interest payment is around $28.50 per month. Let's assume two things happen over the next 5 years. You make only the minimum payment each month, and the home appreciates at 4% each year, which is roughly the long-term historical average in the US. After 5 years, that $500,000 home is now worth around $608,000. During that same time, you've paid down roughly $42,000 of principal. So here's where you stand. Home value around $608,000. Loan balance around $433,000. Equity roughly $175,000. You started with $25,000 and ignored the one-size-fits-all advice. 5 years later, that turned into $175,000 in equity. Not so bad. Time, appreciation, and consistent loan payments did the heavy lifting for you. This is the power of leverage. Now let's check back with Dave, who's been eating PB&Js, drinking lukewarm office coffee while he paid his landlord's mortgage while he saved up the money. During that same 5 years, the $500,000 home he wanted is now priced at $608,000 because of the 4% annual appreciation. That means 20% down is no longer $100,000. It's going to take $121,000 to get to 20%. But Dave settles on a home for $500,000 that's in his budget, and he puts down his $100,000. While you now have about $175,000 in equity, Dave only has his $100,000. That doesn't mean buying sooner is always the right move, but delaying your home purchase for years so you can save 20% down can cost you a lot more than most people realize. Now, of course, there's more to consider. So let's look at how down payment actually impacts your monthly payment. Let's use the same $500,000 home with a 30-year mortgage at 6% interest. And just to be clear, this is principal and interest only. It does not include property taxes, homeowner's insurance, or private mortgage insurance. If you put 20% down, that's $100,000. Your loan amount would be $400,000. At 6%, your monthly principal and interest payment is about $2,400 plus taxes and insurance. Now let's look at 5% down. That's $25,000, and your loan amount would be $475,000. At that same 6% interest rate, your monthly principal and interest payment is about $2,850, plus taxes, insurance, and private mortgage insurance. So the difference between 5% and 20% is roughly $450 per month. That's real money, and it absolutely matters. But here's the trade-off. To save $450 per month, you had to come up with an extra $75,000 down payment up front. For some buyers, if you already have that money sitting in the bank, it might make sense. But for others, having that $75,000 available as reserves, emergency savings, or to pay off higher interest debt could be far more valuable. And if trying to save that extra $75,000 delays your purchase for years, it almost never makes financial sense. You have to look at the full picture and how that decision impacts you long term. Here's a quick note on first-time homebuyer down payment assistance programs. As you have probably heard, these programs do exist. And for the right buyer, they can absolutely help, usually with down payment, but sometimes also with closing costs and slightly lower interest rates. But understand, they often come with income limits, purchase price caps, and additional conditions, and sometimes there are repayment requirements if you sell the home or refinance. Like everything, there are trade-offs. And while you might qualify, whether it actually puts you in a stronger long-term position is another question. That answer will be based on the particulars of the program and your unique situation. Now that you understand everything about down payments, you might be surprised to learn that's not the only upfront cost. You also need to plan for closing costs, which typically include lender fees, appraisal, title and escrow fees, and prepaid property taxes and homeowner's insurance. In the Portland Metro, closing costs are often 2 to 3% of the purchase price. This depends to some degree on when the closing takes place in relation to the property tax cycle. On the $500,000 home in our example, that's roughly $10,000 to $15,000 and can be more if your lender and you decide to buy down the interest rate. Here is the importance of strategy. We can often negotiate with the seller to cover some or all of the closing costs for you. In some cases, they will agree to this in lieu of a price reduction, but if a price negotiation isn't an option, we may still be able to offer over the asking price in exchange for a credit of equal value. To be clear, this strategy doesn't necessarily save you money, but it does significantly reduce how much you need up front. Inspections are another cost that you need to plan for. A standard home inspection is usually between $500 and $1,000, depending on variables like the age and size of the home. Specialty inspections like sewer scopes, radon testing, and for older homes, oil tank scans can add even more cost. For rural properties, we may need to do a well water test or a septic system inspection. These are out-of-pocket costs, and they need to be paid for in advance. They are also some of the most important dollars you'll spend. Skipping inspections to save money is one of the fastest ways buyers get burned, and realtors who don't caution their clients against skipping them often end up in court. Here is another point to consider. Sometimes your cash is better used somewhere other than down payment. Paying down certain debts can improve your debt-to-income ratio and help you qualify for a larger loan. Reducing credit card balances can improve your credit score and reduce your interest rate, as well as improve your debt-to-income ratio. And holding reserves can strengthen your overall financial position. This does not mean you should rush out and pay everything off. Have this conversation with your lender first so your strategy improves your position and doesn't accidentally hurt your loan approval. Another question I get asked all the time is where your down payment can actually come from. The good news is, it doesn't have to come entirely from your hard-earned savings. One common source, for those who are fortunate, is a gift from family. Parents or other relatives can gift funds towards your down payment and closing costs. The key is that it must be a true gift, not a loan. No expectation of repayment and no side agreements. And the lender will require a simple gift letter confirming this. Another option buyers ask about is retirement accounts. In some cases, it may make sense to withdraw funds early. A better option, if available, is borrowing money from your retirement account. I actually used this strategy once for one of my own home purchases. Borrowing from my 401k gave me the down payment funds needed, and I repaid it over time through payroll deductions. These strategies can work, but they need to be handled carefully. Early withdrawals can trigger taxes and penalties. Loans must be repaid and can impact your monthly cash flow. Before moving money, have this conversation with your lender, tax professional, and if you have one, a financial advisor. One more detail people often overlook is something called seasoning. Lenders need to document where your down payment and closing costs came from. Typically, money needs to be in your account for about 60 days before it's considered seasoned. If a large deposit shows up without a clear paper trail, it can create delays and additional documentation requests. I once had a buyer try to pay his down payment with nearly $100,000 in $20 bills that he'd been saving. Needless to say, things got complicated real quick. It doesn't mean you can't use the money. It just means that we need to plan ahead so it doesn't become a problem. The goal isn't just getting you into a home, it's getting you there smoothly without last-minute surprises. So, how much down payment do you really need? Enough to qualify for the loan, enough to feel confident with your monthly payment, and enough to leave yourself a little breathing room after closing. I'm guessing that number is a lot less than you might have expected. So next up, I'll talk about how to actually find your new home, setting up a smart home search, how to avoid missing great homes, and how search filters actually work. Here's a hint, it's all about balancing focus and flexibility. If you want help figuring out the right down payment strategy for your situation, you can schedule a buyer consultation through the link in the description. And if this info has been helpful, give it the thumbs up and leave a comment so the algorithm falls in love with my channel. And of course, don't forget to subscribe so you can see the rest of the series.